This video examines the Great Unraveling 2025, detailing how a tariff shockwave triggered a record bankruptcy surge in America and beyond. 2025 saw a 15-year high in corporate failures. Between January and November, 717 U.S. companies filed for bankruptcy, a 14% increase from 2024. Companies facing financial pressure follow two paths. Chapter 11, reorganization to restructure and continue operating, or Chapter 7, liquidation, which ceases operations and sells assets. The 2025 surge forced companies down both paths, signaling severe financial pressure. The crisis's epicenter was a protectionist trade policy using tariffs as an economic weapon. While intended to protect domestic industry, the immediate effect was a sharp increase in the cost of imported goods for U.S. companies and consumers. The first ripple was a wave of inflation. U.S. inflation surged to 2.7% as tariffs raised prices, a significant shock for an economy targeting inflation below 2%. The inflation was cost push rather than demand pull. Against traditional economics, the U.S. pursued an unconventional path, cutting interest rates to counteract the financial pain from tariffs. The interest rate cuts failed to stimulate consumer spending because high prices remained. Capital, instead of flowing to consumer goods, diverted to the stock market. Companies faced high tariff-driven costs and stagnant consumer demand. The domestic fallout included businesses and jobs under strain. The unemployment rate climbed to 4.6% as companies failed. Small business importers faced an estimated loss of $25,000 per month due to the direct cost of tariffs. Industries heavily dependent on imports suffered the most significant damage. The industrial sector saw the largest increase in bankruptcies, including construction, manufacturing, and transportation. Other affected sectors included consumer discretionary, healthcare, consumer staples, and IT. A case study in distress is At Home Group, a major U.S. home furnishings retailer. Facing unsustainable costs from tariffs on imported goods, the company filed for Chapter 11 bankruptcy to reorganize its finances. Beyond bankruptcies, even corporate giants stumbled. Many of America's largest corporations experienced significant drops in profitability due to tariff-related costs and supply chain disruptions, including GM, Walmart, and John Deere. Nike projected an extra fiscal loss of $1 billion for 2026. This was primarily due to the disruption of its extensive supply chain in Vietnam, a direct consequence of the new tariff landscape. The economic consequences were not contained within U.S. borders. The shockwave crossed the ocean, and India, as a key trading partner, felt the impact directly and immediately. The United States is India's single largest export market, accounting for 20% of its total annual exports of $434 billion. On August 27th, the U.S. imposed a 50% tariff on Indian goods. As a result, Indian exports to the U.S. experienced a 20% year-on-year plunge in September. The policy came at a cost to India's national growth. Goldman Sachs estimated a negative 0.6% impact on India's GDP from the tariff, and Moody's downgraded India's projected GDP growth for 2026 from 7.0% to 6.4%. Key export-oriented sectors in India were directly affected by the U.S. tariffs, including textiles, leather goods, gems and jewelry, engineering goods, auto components, and steel and metals. One policy triggered a global chain reaction. From U.S. tariffs to domestic inflation and corporate distress, 717+ bankruptcies, global trade disruption, and a significant hit to India's GDP. These events are a stark reminder that in a deeply interconnected global economy, no policy is an island. The key question for 2026 is whether negotiation can mend the fractures.